Rader. I'm the head of research at Ray White, and today I'm over in WA, which is really exciting, and we're going to be talking about all things industrial. So welcome our panel members. We've got Chris Matthews. Welcome, Chris. Chris is the Joint Managing Director here at Ray White Commercial, and also we've got Tom Jones, and Tom is the licensee of the business. So welcome, Tom.
Thank you.
Exciting to have you guys here. Talk about industrial. Industrial is so exciting.
Yeah.
It's probably the asset class, it certainly is the asset class that has performed the best over the last, 5 or so years. During COVID in particular, we saw a whole lot of inquiry into the industrial market. We saw volumes at record highs really during that kind of 2001, 2022 period, 2021, 2022 period. We saw, vacancies, record low levels. So what's happening today? What's happening here? We've seen volumes come back a little bit, but what's happening today for the industrial market here in Perth?
Yeah, well, it's still going. There's a fair bit happening. Volumes are definitely down, but we personally feel that it's more to do with supply more so than demand. Demand is still off the charts high. There's plenty of people looking, plenty of investors, plenty of occupiers. If the supply was there and properties were on the market, we do feel those volumes would be higher up. Lots of tenants looking around as well. Still a very low amount of vacancy, so there's just not too much to transact at the moment. But hopefully that changes, but time will tell.
Yeah, and we're certainly seeing this inquiries are coming from all size ranges and locations.
Yeah, definitely. I think the sub 500 represents still circa 50% of the availability. The inquiry level is very strong still for that category. When you go to your 2,000 square metre buildings, obviously there's a lot less supply, like Chris mentioned. There's also a lot less tenants looking for it, but there's still a major bidding war going on to secure space.
So where is all this inquiry coming from? Who are the purchasers?
Well, it's mixed. I mean, there's the big ticket item, big prices, I guess, is the occupiers. They're outstripping the investors by far.
Yeah, we've seen that. The owner occupiers are really
driving
a lot of that.
Yeah, so you end up with if you've got a property that is coming on vacant, usually an occupier will wait maybe 6 to 12 months as a maximum period of time before wanting to move in. We're finding that if there's 2 to 3 years left running on a lease and there's no options, you'll still get occupiers coming in and paying a number that is well beyond what an investor will pay. So our advice often with a lot of property is you're better off selling it vacant because that's where you get your premium from.
Wow.
Even though the rents are still quite high, when you apply a circa 6% yield to that, you'll find that the vacant possession price is a lot higher. Could be 10, 20%. You just need that kind of one keen occupier who's ready to come in and pay the number.
So you say occupier, so they're like local businesses. Is there any particular business that's more prevalent than another, or is it like construction? Or?
Yeah, a lot of mining services naturally, being WA and a mining town. The smaller space, probably sub 500 square metres, is heavily driven by a lot of man caves. I know Tom sold quite a few at pretty healthy numbers in Aussie Park.
Sorry, what sort of size are they? Sub 500 or even smaller?
Sub 200.
Wow.
I think it's more or less the baby boomers are starting to move into their smaller apartments, and there's they used to have these big sheds in the backyard that they no longer have access to.
So we're talking about caravans, boats,
toys,
all the fun stuff.
Yeah. Okay. Well, that's an interesting part of the market. And how about the investor space? So we talk about the owner occupiers. Yep. The investor space is still pretty strong too, I understand.
Very active. Yeah. I mean, I'd go to a point of saying that whenever we advertise a property, we end up getting more inquiry from investors, but the price is that the occupiers are happy to pay the higher price.
It's something that we I feel like we haven't seen that before in quite some time for the industrial market. I suppose that kind of lends itself to the fact that the vacancy is so tight.
Yeah.
But these investors, are we talking about local investors? Are we talking about investors coming from interstate or offshore, or where is the money coming from?
Your sub 1 mil are definitely coming from interstate, from Sydney, Melbourne markets, where they're probably used to a lot tighter yields than what we experience over here. The local buyers, unfortunately, the local investors are completely missing out on the opportunity because they're still expecting the 7+% returns.
Yeah.
Where the New South Wales and Melbourne markets are sub 6 a lot of the time.
So anything that still has like a 6 in front of it seems like good value to them.
Yeah,
but
definitely.
Like locally, it seems overpriced.
Yeah,
Is that what's happening?
For the industrial stuff, we see probably sub 6s a little bit more often than not. If it was the larger assets, I think they're probably expecting slightly higher returns. But the sub mill's definitely very tight.
I know, speaking with a lot of our businesses around the country, this kind of small private investor market has actually grown quite considerably, despite the fact that finance is a bit more expensive, and that's a lot to do with kind of the growth in the commercial buyers agents.
Yep.
Are you getting? Well, that's a talk a lot that's happening on the East Coast. Are they're coming and talking to you guys over here, looking at opportunities here as well? Do you think that's driving some of kind of these investors that probably weren't here before, perhaps got a little bit more sophistication behind them, or they've got kind of the help of someone?
Yeah, the confidence backing I think is definitely there. I mean, it's for me personally, if I were looking at buying a property and I was going to go interstate. It's funny, it's your country.
You'll call me.
Yeah. Like, hey, V, I need some help on something here. The issue is, I guess, understanding what's where, and you think about Perth as this place, and if you don't know where suburbs are in location, and what do you need to look out for, and I guess that's where all these buyers agents are really getting involved, and they know the market well. They've actually got feet on the ground here now. So what amount, percentage-wise, a lot of those kind of leased investment transactions are coming from those eastern states buyers agents that are, without them, we'd probably be losing out a fair
most
bit.
of them are off market as well, so that they don't even come or they don't even get put forward to local buyers anymore, just because there's not much point. If the money's coming from that way, it's much tighter than it's ever been. We kind of just bypass the locals and just go straight to the contacts over there and get the deal done. So,
wow.
Yeah.
Well, that's an interesting time. And like you said, like a lot of people don't know the fundamentals of the suburbs and things like that too. So to have that local expertise, I suppose, is
I guess they're vetting the rent, the length of the lease, the quality of the tenant, all that stuff that you'd be really concerned about. And then ultimately they give their recommendation. We do have a little bit of back and forth with them, I guess, on the price because they're trying to get at a number that you wouldn't get something for locally.
Yes.
Yet if it is
they're working for the purchasers.
Ultimately. So I mean, they've missed out on a few to some other investors who aren't acting through a buyer's agent. We had one in Kewdale just recently that they're a couple $100,000 off the mark on a 3.4 mil sale, but open communication on the way through. And they said we just can't recommend any higher price than what we're going to pay or what they're going to pay.
And in terms of the leasing market, we've vacancies still are really tight. We've seen that kind of huge rental growth that we saw a couple of years ago start to dissipate a little bit. Like, that's not saying rents aren't going up, but they're just not going up to the same level. Where do you see rents at the moment, and where do you think that they're going to go? Or do you want to not answer that question?
Who knows? It is a tough one. Me personally, I've found that there are transactions at 180 plus a square metre for warehouse space, which is crazy considering that a lot of suburban office space will lease at that or less. When you consider a business that is maybe, I'm trying to quite understand how people justify paying that amount of rent. I guess as a proportion to your total turnover, that expense isn't significant enough to go, well, your choices are you either continue treading water and don't take on that additional space and don't grow your business, or you've got a contract, you need the space, and you've got to basically get a bigger property to move and get things rolling. Rental growth, though, supply is so tight. Fundamentally supply and demand, and that's what's going to drive the price. So the issue that we've got is there's no real supply coming on to taper off that sort of premium rental figures that are being paid. And it's also cyclical, and not trying to put a negative spin on it. I was fortunate enough to be around in the 2008 to 2012 period and saw that once the GFC hit. And
I'm not sure fortunate is really the right.
I was fortunate. I think it gives you
learning.
background. It was a learning curve. I say fortunate because you get to see how the cycles kind of work.
And they can change quite quickly.
Yeah, they do. And we saw rents spike, values spike. GFC hit in 2008. and I think it was WA and Queensland just kept cranking on. And if you look at that same sort of cycle, the only thing that's really changed is COVID cash that's come in, and that's a huge. There were so many other stimulus things that the government did to make sure that the country didn't go into recession during that COVID period. I'd love to actually see the stats in about the amount of money that they tipped in, because that multiplier effect, and it's just flowed through the whole country. I think WA were fortunate because just prior to COVID, things started ramping up anyway. It was at the beginning of 2019 and we got 1 year in before COVID hit, and then we thought everything was gone, ruined. Then all of a sudden, COVID cash. And we didn't really have lockdowns here. I think we had 2.
Not to the same extent as the rest of the country.
No, that's it. So I think as an overall stimulus package that the rest of the country probably needed it, whereas here we continue to trade. And there's a lot of, like a 30-staff business, if you went and got the JobKeeper payments alone, there was a cash flow boost that they did here in WA. We worked it out because I thought, well, where's all this money coming from? And if you had 30 staff in your business, that incentive over a 6-month period was worth about $500,000.
Wow.
So if you're continuing to trade, not the same, but probably better than what you were because of all the rest of the money that's been tipped in, you're just parking that cash. So I guess that's where the owner-occupiers and maybe even investors have kind of come out of the woodwork a lot.
Yes.
Where we're going to park that money, it's not safe to put it in, stocks are pretty volatile. No one knows what's happening with the global economy. It's sort of all up in the air. And they go, well, why don't we buy property because you can see it, you can touch it. So rents, I think, will probably, I don't think they're going to continue the way that they have.
Yes.
There'll be
but the fundamentals of supply and demand aren't going away. And how about incentives? I'm assuming, Tom, that there's no incentives then in the market, or very limited.
They haven't completely disappeared. The larger sheds, you will still, get your 1 to 2 months rent free just to allow for that relocation time period. But if you have multiple tenants interested in the same property, then, that starts to slice off pretty quick. And you don't see it as often as you used to. Yeah.
And so new supply. So really we need to see new supply coming to the market to probably moderate kind of some of that rental growth maybe, and just there's demand for it, so we really need the new sheds to be there. But the problem is, like any other asset class, I suppose, a lot of these projects are just not stacking up. The cost of construction, the finding available labour to build it, what's happening with the builders has become quite difficult. So, and if you are building a new project, it is then you're talking about the rents, it's setting that new economic rent in order to build the project. So, what's going to happen for the new supply? Do you think? Is there some, you also are constrained land here in WA
that's probably,
too?
Well, the supply is not going to come from anywhere other than once land becomes available. Even if it does become available, then you've got the infrastructure problems. So Western Power are taking anywhere up to 15 months to get a new power connection.
That servicing piece is so important. A lot of people just don't even realise it, and it's such a hold-up for bringing on new land. Sorry to interrupt you.
No, that's all right. We had, not an industrial front, but we put together a GYG on Great Eastern Highway, and it's my favourite little war story. But we had, the building was complete, everything was done aside from the power. So GYG said, look, we want to get trading. This is one of our iconic stores. We're going to get it up and running. They paid for the cost of a generator at about 40 odd K a month, including fuel. So they ran that for about 15 months up until the power was actually connected. So it took Western Power that long to get it up and running properly. And unfortunately, the owner at the time had to, that was Owner's Works. So they had to go, well, we can either sit with a vacant building or we can put these guys in here and at least get some outgoings. And if the building went vacant for more than 3 months, insurance becomes an issue. So kind of forces your hand a little bit. So on an industrial front, actually getting the supply of land out there, it's all well and good to get the zoning done. There's obviously a lot of red tape there, but having it rezoned, actually then subdivided, power, building, occupy. It's a long process, and I do feel that in another, even if you started something today, you might be looking at 18 months before you've got it ready for a tenant to move into. So supply demand, if demand does taper off a little bit, we could be in that transitional period where, if demand does start to taper off in the next few years and supply comes on a little bit, I do wonder where things will be at in another sort of 24 months' time, keeping in mind that 08 to 2012 period that we had. Once mining dips off here, my concerns about the demand for space, it may have tapered off a little bit, but it doesn't see any signs of slowing just yet. It's kind of like,
and given this kind of long runway needed to bring on new supply, you'd think that like it would be quite slow to be added, and
so we might see a little bit of rental growth still.
Yes,
which is crazy. Just blows my mind. We're down Forestdale way. I had a tenant that was very keen on a building. The timing just didn't work out, but they were talking about $160 a square metre for rental, and it wasn't that long ago you could buy land at that figure. It's just mad to think of that sort of number in that location.
And is there locations that we've seen more rental growth than others, or is it kind of there is lack of supply, so everything's just kind of gone up? Is there pockets that are? I think
if you're within 25 to 30 kilometres of the CBD, you probably shared in the same sort of growth. The issue that we've got is that people watching will probably think you're in Western Australia. There's plenty of land around. There is. But as soon as you go 30 kilometres out of the CBD, then businesses, whilst they can secure the land for under $200 a square metre, which is less than half, they've got issues with workforce wanting to head out that way. And they just won't take the risk in what is already a very hard, employment market to then move and then have to hire staff again. So I think that's the main issue is, the land that is available is very expensive, and then the timeframes to get it up and running are problematic. Yeah.
And then if you do, then you're setting that new economic rent, like I said, which is,
you have to,
difficult for, some occupiers, but it has to, otherwise you're not getting the new supply coming out of the ground.
You really need to be getting 180 a square metre to make it stay. If you're paying 600 a metre for land, you're building a warehouse at 1350 a square metre, complete, ready to move into. 180 a square metre would probably get you about 7-ish% roughly, but it's the risk and the time frame to construct. So that doesn't include all your holding costs and that on the way through. So if you're holding that for 18 months and you load that cost in there, you might be around mid-sixes. So I guess as an investor, you say, well, am I going to go out there and buy land and do this, or can I just go buy that one over there that's got a tenant? I don't have the hassle or the risk, and it might be 0.5% less yield.
So maybe is it owner-occupiers that might be building their own asset that's really attractive to them then? Because they can build it to suit their needs, they can stay there, and they're happy to pay a little bit over because it's going to be their forever home, if you like.
Build it be an interesting stat, and I'm confident it would be this way, is that if you took the last dozen land sales around the place, I think you'd find that most of them will be occupiers on the normal scale, as in probably maybe 2 hectares or less. I do feel they would be all owner-occupier sales. Some of the rates that people are paying for land at the moment, it's pretty crazy. And when you look at it and you say, well, how can you pay, I think the last one was $660 a metre in Welshpool, and you look at that and go, well, unless you're getting $190 a square metre for your rent, there's no point. You may as well go buy a leased investment. So I would bet that one will be an owner-occupier as well. I know John Hughes just picked up a block for around $750 a square metre on Welshpool Road. Again, owner-occupier adjoining site, so a bit of a premium. So there's big numbers being paid. And again, as that investor, you're struggling against that owner-occupier market. Even if you wanted to, as an investor, buy land, build something and put a tenant in, you're having to bid against these occupiers that are paying these huge rates.
Yeah. And how about secondary assets? So given that there is a limited depth of stock in the market, is there really a prime and secondary market clear, or are people having to, if they need the space, they need the location, they're just having to take what's available to you? I don't know, the secondary assets see as much of a discount as, is that kind of getting a bit closer together? And similarly for investment, investors looking, okay, well, it's a secondary asset, but at least it's a built form. If I had to redevelop this myself, like it wouldn't kind of stack up. So a secondary...
I think just with the pinch of space, people are just taking whatever they can get their hands on, and potentially looking at refurbishment rather than brand new construction. But they've got little choice, so they'll just get what they can.
Yeah.
Wow.
Yeah, pretty much.
And
so.
investors too?
Yeah, to a certain extent. I mean, if you've got much older buildings, that there was a period of time where those secondary buildings would sit on the market for 12 months and they're practically unleasable.
Yes.
And the rates were really low. We did one on Division Street in Welshpool, and it was an old tin shed, very basic. It was about 1,500 odd square metres. In a normal climate, it would have sat vacant for that long, would have got 50 a metre. So you're looking at 75 grand. We got $100 a square metre for that thing because it's available space and it's ready to go. So that's on a leasing front. And then on a purchasing front, traditionally we will go, well, what's it worth? Land, cost of building, and then usually depreciate the building. If it's a 10-year-old building, the logic would be if you can buy land and build something brand new, wouldn't you rather do that? Versus buying a building that's a bit older. You'd probably still buy it, but at a little bit of a discount. But I'm finding now that with a lot of these occupier sales, they're basically saying, well, if the building's there and it's ready to go and we don't need to enter into the construction world and wait 18 months, we'll just pay full tote odds for it right now. And it's even the case that we sold another older one in Kewdale that had been semi-refurbed, but it was a tin shed, metal clad. It wasn't tilt panel, and they effectively near on paid tilt panel rates for it because it's square metres available now. So it's interesting that I guess if it's available now and it's ready, people are happy just to jump in and not have the hassle of sort of building and pay that premium.
Wow. Well, that's, But like to your point earlier, does that kind of give you some concern or some kind of like
I've been
moment
concerned for 12 to 24 months now. Some of the prices have just been, when we first started kicking off in this cycle, and then with COVID, probably even during that sort of high volume period of 21, 22, you just saw figures that as an agent, your job's to get the highest price. And when you're going off a sales evidence, you're relying on the past sale. But when the market's doing this, you have to kind of pick where it's going to go. And we've been doing that, but some of the sales I've been doing, it surpasses what your higher expectation is again. And it's
at the end of the day, it does come back down to this whole issue of demand and supply.
Yeah.
And if there is the demand for that space, and as we haven't even spoken about the fact that there's been huge population growth here in WA, it doesn't look like it's going to kind of slow down. You've got interstate people coming here as well as people from overseas. Labour market, which is really strong, unemployment remains really low. So fundamentally, all those indicators are pointing at, increased need. There is, know, and if there's only so much of it and the construction prices aren't going down, they've said it, they continue to go up. Their level of growth has slowed down, but they're not going to go back to where they were. The labour is an increasing issue. So, while some of it does kind of look a bit concerning, just looking at those kind of fundamentals would suggest that, this is the new way forward for industrial in Perth.
The new norm.
Yeah.
Yep.
And it's really those fundamentals that we're seeing around the country, and the fact that you do have the constrained land piece that a lot of people probably don't understand in WA or in Perth, is a big piece of that pie that's really continuing to drive that. And that's not going to be sorted out overnight.
No, I mean personally, I feel that the thing that will bring the prices back into check will be that demand dropping off, and that will come with the inevitable downturn of mining like we do have, unless there's another sector that starts to fire, like some of these renewable energies or something like that, to keep our output as a state. If you look at what we do put out in iron ore, it's a significant part of that. So once that tapers off, and if you look back at 2012, it was all happy, and it can tend to drop off a cliff, So it happens quickly, but and there's a lot of factors worldwide at play there that it's too hard to depict when that's going to happen, but.
So we've been talking about the small end of the industrial market, so that owner-occupiers in that kind of private investor space. What about the big end of town? Is there still, we know that industrial from all that kind of listed funds and offshore funds were coming to invest into industrial no matter really where it was. It became the golden child of investment, if you like, particularly during COVID. Yields super tight, unlike they've ever been seen before. Not too many transactions actually have occurred in Perth in that side of the market for the last couple of years. I suppose there's not a huge amount of supply. Well, there is. There's, you've got still large logistic type uses distribution facilities here, but a little bit quiet.
It's an interesting dynamic in that where we get a lot of the, say, sub 6 mil sales, you get a lot of investors that are either grouping their money together, even some buyers agents that will group a few people together.
Like little private syndicates.
Yeah, almost like that. And they get better buying power. So I'm finding that there's a very definitive shift between that sub 6 and in excess of 6. Every time we've got some decent chunky leased investment asset to sell, we've got any number of syndicators, or we've got REITs that are looking, but they need 7+% to make it work. Anything less than that, and by the time they do what they do, take their management fee and give their return to their investors are going, well, why wouldn't I not just put it over here and not have the risk of the property dropping off in value? So I'm finding that they're active, but they're not really able to sort of buy at a rate that people are willing to sell for. And I guess once that, it's if there's an interest rate shift, that's obviously going to follow. But then if it increases, they're going to want a higher return. So it's, part and parcel.
Yeah, so like it is an interesting part of the market. And so are things like data centres and self-storage facilities and things like that, which is really not necessarily self-storage, but that data centre, that's a big end of town and something a little bit different. So we're nearly out of time now, but let's just kind of wrap up and have a little think about, and I'll start with you, Tom. Yep. Where do we see, if we've just been saying everything's so constrained and it's quite difficult, but where is the opportunity in the industrial market in Perth, or I'm sure there is an opportunity.
Yeah, there is. I think there's definitely an opportunity, just because the investor market from over east is so strong, for a lot of business owners in Perth to probably cash out and do leasebacks, sell their building while prices are high, sign 5-year leases at what would be good rents, but they're definitely going to get the back end of that payment, in the sale. So if they're looking for fluidity of bringing the money out and putting it back in the business, then it's, perfect timing.
Are you seeing many of those happening? Because that seems like
so a lot of the East Coast buyers agents, the deals that they're doing are primarily leasebacks.
Yeah.
And we just have to basically draw up the full contracts and push them through the hoops to get them to that stage. But I would say that it's a large portion.
Well, that's a really good result, because otherwise these assets aren't coming to the market. Like you said, the local owners get to unlock some of that kind of good capital growth that we've seen, and then that investor's happy to come in on that lease investment term. That's a good way to structure it for a bit more activity to continue to go on. And how about you, Chris?
Yeah, I think that's a valid point, because that's where I'd see the opportunity from an owner-occupier perspective. There's, without sounding too blunt, there's not really any opportunity. You're just in the pool with every other person. If you can get it off market, I strongly advise all sellers about doing off-market transactions, purely because obviously we're here to create competition, right? So the more of those occupiers you get in a pool, then the more competition there'll be. Probably now for occupiers, it's still going to be pretty tough. Investors, if they could either find a lease that is quite detrimental, in that if there's not a market review for another couple of years, you might have a below market rent for now, and you might carry a low yield for the first 2 years, but once that market rent comes in, it will increase the yield. So that's a possibility. And then potentially, if the demand does shift and that flight to quality is there, where everyone's going to want a nice tilt panel building, maybe repositioning some assets, some older industrial ones, and bringing it up to standard.
Yeah, so to buying the asset today that is getting that return, albeit it may be slightly below market, with a future objective with redevelopment or something.
Yeah, some angle, but it's there's that much competition there.
Yeah, it's hard to find that.
People will price it and they'll just go, oh yeah, we know that's going to be that. So then you've got 10 other buyers that are thinking the same way. So it is still very competitive. But,
anyway, I think our time is up, and I really enjoyed talking about industrial. I think that the WA market is so interesting, in particular Perth, that industrial sector, and that small end of town seems to be quite busy with a lot of kind of moving parts, and it still does show good value, particularly if you are an East Coast investor looking to buy. So thanks so much to Tom and Chris for joining us today. I hope you guys got something out of it. As always, you can go back and watch these on YouTube, and also jump on Spotify and just search up Ray White Commercial or Between the Lines Live, and I will catch you next time. So thanks again.
Welcome.
Thank you.